All right, in the next few minutes, we're going to pull back the curtain on one of the most powerful tools in all of business, the balance sheet. This is the absolute key to understanding a company's financial health, and we're going to break down exactly how it works piece by piece.
So how do you really look inside a company? I mean, to see its true underlying structure? Well, you'd need something like a financial X-ray. And that's pretty much exactly what a balance sheet is. It's a snapshot, just a single picture taken at one specific moment in time that reveals the fundamental truth of what a company owns and what it owes. So let's get that X-ray up on the screen and see what it shows us.
Here's how we're going to tackle this. First, we'll get a handle on the core idea of this financial snapshot. Then, we'll dive into what a company owns, what it owes, and what's left over for the owners. After that, we'll get into the fun part, how to analyze it and understand the story it's trying to tell us. Okay, let's start with the most important idea. Every single balance sheet for every single company is built on one simple, totally unbreakable rule. You can think of it like the law of financial gravity. And here it is. Assets must always equal liabilities plus equity. This is the fundamental accounting equation. All it's really saying is that everything a company owns, all of its assets, had to be paid for in one of two ways. Either they borrowed the money, which is a liability, or the owners put up their own funds, which is equity. That's it. It has to balance every single time. So let's start on the left side of that equation with assets. What does a company actually own? Well, it can be pretty much anything, from cold, hard cash in the bank to big, abstract ideas. So what exactly makes something an asset? The official definition is actually pretty simple and really powerful. It's any resource the company controls that's expected to provide a future economic benefit. And that's the magic word right there, future. An asset has to have some kind of value down the road. Now, assets aren't all the same. They're split into two big buckets based on how quickly they can be turned into cash, what we call liquidity. You've got your current assets, which are things the company expects to use up or convert into cash within a year. And then you have your non-current assets. That's all the long-term stuff, like buildings, machinery, things that are built to last. Diving into those current assets, you're pretty much always going to see these three. First, you've got cash. That's easy enough. Then there's accounts receivable. That's just money that customers owe the company for stuff they've already bought. And finally, you have inventories, which is all the product sitting in a warehouse waiting to be sold. But holding on to assets, especially inventory, can be really risky. Just look at Cisco back in 2001. Demand for their products suddenly just dried up. They had to write off more than $2 billion worth of inventory. It's this incredible reminder that just because something is called an asset on paper doesn't mean it's going to translate to cash in the real world. Now, when we move over to non-current assets, we can find some really fascinating stories. Take a look at goodwill. It's this intangible thing that shows up when one company buys another. Now, check out this chart. For the software giant SAP, goodwill is a huge 37% of its total assets. For HP, it's almost 29%. But for Apple, it's basically zero. This tells you so much so fast. It tells you that SAP and HP grew by buying up other companies, while Apple's growth has been mostly organic. And it also hints at a big risk. If those acquisitions don't work out, that goodwill can get written down, and that can mean a massive hit to the company's value. All right, let's flip over to the other side of that core equation. We've talked about what a company owns. Now let's talk about what it owes. These are its liabilities, all of its debts and its obligations. And just like assets, liabilities are also split into current and non-current. Current liabilities are the bills that are due within the next year, the stuff you have to pay off soon. Non-current liabilities, well, those are the long-term debts, like big bank loans or bonds that aren't due for a long, long time. Some common liabilities you'll see are accounts payable, which is money owed to suppliers, and notes payable, which are just formal loans. But here's a really interesting one, deferred revenue. This is cash a company has already been paid for a product or service it hasn't delivered yet. Think about a software subscription you pay for annually or a gym membership. It's a liability because the company still owes you that service. And for some businesses, this can be a fantastic way to bring in cash up front. So, we have what's owned and what's owed. That just leaves the final piece of our puzzle, what's left over for the owners. This, my friends, is called equity. If you just rearrange that main equation a little bit, you see that equity is simply your assets minus your liabilities. It's the residual claim. After all the debts are paid off, whatever is left belongs to the shareholders. It's really the net worth of the company. It's made up of the money investors first put in, plus all the profits that have been plowed back into the business over the years. And that is what really fuels a company's growth.
Okay, so we've got our three main components: assets, liabilities, and equity. But just knowing what they are isn't really enough. The real magic happens when you learn how to read between the lines and turn this financial snapshot into some real insight.
One of the best ways to do this is something called common size analysis. And it's so simple. You just take every single item on the balance sheet and you show it as a percentage of the total assets. This is an absolutely brilliant little trick because it lets you compare companies of totally different sizes or see how one company is changing its strategy over time. And this is where that kind of analysis just blows the doors off a company's strategy. Take a look at Company A and Company C here. On the surface, they look kind of similar, right? They have the exact same percentage of their assets in cash. But now look down at how they're financed. Company A is almost 100% funded by its owners, by equity. Company C, on the other hand, is almost entirely funded by debt. These are two fundamentally different businesses with totally different risk profiles, and this simple analysis makes that crystal clear in about 5 seconds. Another classic tool you'll see is the current ratio. It's super simple. You just divide your current assets by your current liabilities. It's a quick, back-of-the-envelope test that answers one of the most important questions there is. Does this company have enough cash and other short-term resources to pay its upcoming bills? Let's look at this in action with SAP. Back in 2008, its current ratio was 0.96. That's less than 1. It means its short-term debts were actually bigger than its short-term assets. That is a pretty risky place to be. But check out what happens by 2009. They boosted that ratio all the way up to 1.54. And what's really interesting is they didn't do it by growing their assets. They did it by slashing their current liabilities. That gave them a whole lot more financial breathing room. So when we pull all of this together, what we see is that the balance sheet isn't just some boring list of numbers. It's a structured story about a company's financial condition. But just like any story, it doesn't always tell you the whole picture. So what's the bottom line? A balance sheet shows you a company's ability to pay its bills, its overall financial risk, how it's funded, whether by debt or by equity, and, like we saw with the goodwill example, it even gives you big clues about its business strategy. It's an unbelievably powerful diagnostic tool. But, and this is probably the single most important limitation you have to remember, the value you see on a balance sheet is its book value. That's based on historical costs and a bunch of accounting rules. It is absolutely not the company's market value or what it's actually worth in the real world today. And that's because the balance sheet just can't capture everything that creates value. And that leads us to our final question. The balance sheet is a fantastic story written in the language of numbers. But what about a company's most valuable assets? You know, the ones that you can't really quantify, like a world-class brand, an incredible reputation, or just visionary leadership. These are often the things that make a company truly great, and they're the assets you will never, ever find listed on a balance sheet.